Hey guys, welcome to The Market is Open. In this video, we're going to talk about Tesla's record deliveries for the third quarter of 2020. Then we'll look at Tesla's disappointing deliveries for the same quarter as analyzed by a Forbes article, so we'll tear that apart for you. And finally, now that we have the delivery numbers, I'll estimate the profit and financials for the quarter, which Tesla usually reports in about a month from now. But first, please hit the bell button to subscribe and be notified of upcoming Tesla videos, and smash the like button at any time to help support this video. You can also support the channel at patreon.com/themarketisopen, where we give a shout out to our patrons at the end of each video. Also, stop using Yahoo Finance, stop using Google Finance, and have a look at our website, themarketisopen.com, where we have instant stock quotes and financial data for every single company going back 9 years, and it's all freely available. Tesla reported record deliveries in the third quarter of 2020, as you may know, coming in at 139,300 vehicles delivered. That means that the paperwork is signed, sealed, and complete. This is actually a slight estimate, as the numbers could still change by a small margin, like 0.5%, but what I think is even more impressive is that they produced 145,000 vehicles. I think this is pretty important because it could give the next and final quarter of the year a little bit of a boost as they try to draw down the inventory and deliver as many cars as possible by the end of the year to try to hit that 500,000 vehicle estimate that Elon Musk has set for the company. Compared to the prior quarter, where Tesla's Fremont factory was shut down for half of the quarter, this is a gigantic increase. Look how they delivered more cars than they built last quarter. That's easily explained because they had cars from the quarter before that. But now you're seeing production ramp up dramatically. That's an astounding 76% production increase over the last quarter and 53% increase in deliveries. But the Gordon Johnsons of the world were saying how this quarter wasn't that impressive, but what they kept missing is that Tesla's factory wasn't operating for half the quarter, while the people who have the slightest shred of forward thinking were anticipating how this would affect the following quarter, and we saw huge increases in Tesla's delivery capability. However, not everyone was impressed with Tesla's execution in the quarter. Forbes believes that Tesla's unit sales were disappointing and considered a miss. So let's have a look at what Forbes has to say. Now, to be fair, the first part of the article suggests that there were too many Tesla bulls pumping the stock, calling for over 140 or 150,000 deliveries for the quarter. And so I think a little counterintuitively that this is a bit of a problem actually for Tesla shareholders. The analysts are actually helping Tesla investors now, while the bulls are making it more difficult to own the stock. And that's because the analysts are keeping their estimates low and are actually being conservative. I saw estimates around 120,000 deliveries coming from the analysts, whereas other retail investors, as this person mentions in the article, were calling for 150,000. So I think the latter is doing Tesla a disservice because when the numbers come out, they do appear to be disappointing, even though Tesla executed extremely well. So if that's the point that's trying to be made here, then I agree with that. A second point that Forbes brings up is that Tesla says that they have a 690,000 vehicle annual capacity. If we divide this by 4, we get 172,500 as the maximum capacity for a single quarter for both the Fremont and Shanghai factories combined. So the first point that the article is trying to make here is that even if Tesla were at full capacity for the fourth quarter, they still won't hit 500,000 vehicles for the year. They would be off by about 10,000 vehicles given the current capacity of the factory. So I do agree with this unless Tesla increases capacity in the current quarter. It should be noted that there was a little asterisk here for the Fremont factory, showing that they do plan on raising this to 500,000 vehicles for the 3 and the Y by year end. Of course, we talked about how Tesla may also have a few extra cars in inventory right now, since their production was higher than deliveries this quarter, which could help this quarter a little bit. However, the cars produced on December 31st or 30th or even the 29th probably won't all get delivered this year either, which always happens, but we want to see them draw down the inventory as much as possible by year end. The other point that Forbes makes here is that deliveries only increased 43% year over year, whereas capacity was up 57%, and therefore that was a waste of capital. So my answer to that is to have a little bit of patience. You also have to consider that Tesla could have shut down the factory on certain days this quarter to do further upgrades and boost capacity for the 3 and the Y in Fremont, as we talked about. And they could put 500,000 cars for the year back on the table if that's the case. We'll see what capacity is like when Tesla puts out their Q3 report in a few weeks. Now, in my opinion, Forbes makes two classic mistakes in this next part. The first is that they assume that Tesla only delivered so many cars this quarter because of so-called pent-up demand. This is flat out wrong because, as we've been saying, Tesla is still production constrained. Elon Musk has been saying this, but certain people refuse to believe him. These people will continue to be wrong. One way to prove this is to simply look at the deliveries for the quarter versus production. It looks like they delivered every single car that they made except for a few thousand, which are always in transit at the end of each quarter. We see this time and time again. If Tesla had produced more cars, they would have sold them. Demand is still far outpacing supply, and they haven't even launched their standard range Model Y yet. The Model Y will eventually be 4 or 5 times the volume of the Model 3, and we're not even close to that yet, so there's a long way to go, and this guy doesn't know what he's talking about. The second classic mistake is looking at one specific geography, in this case Norway, and thinking that Tesla is losing to Volkswagen's ID.3. Besides the fact that Volkswagen's cars have significantly less range than Tesla's, VW doesn't write its own software, and the car doesn't look that appealing for a company that's been designing cars for 80 years. Norway is still a small market with huge EV adoption already. While VW is focusing on Norway, Tesla is focusing on China. But really, Tesla sort of shifts around the countries to where the cars are being delivered each quarter, especially in Europe where the vehicles are still being delivered by boat. At some point next year, I would be very worried if I were Volkswagen. I'd be worried about delivering garbage cars when Tesla is trying to change the paradigm with their new Model Y that's built like no other car has ever been built before. Volkswagen sells 10 million polluting cars per year, and they're about to get trounced by Tesla, and Forbes is focusing on Norway and misleading themselves. And lastly, for this article, they look at something called days of sales, which is Tesla's vehicle inventory, that dollar amount, divided by the cost of goods sold that Tesla has been able to push through for the quarter. Tesla says, in terms of days of sales, new vehicle inventory declined further in Q3 as we continue to improve our delivery efficiency. However, Forbes says this statement is misleading because obviously as you sell more cars, as Tesla did, then this days of sales metric will go down because the dollar amount of cars that you sold, the denominator, increases, and therefore you hide the fact that perhaps inventory also increased. So inventory could actually be higher, which Wall Street will never figure out, but Forbes has figured it out. So I disagree with this. This is what happens when you overanalyze, like Gordon Johnson, for example, and you look at the tiny, nitpicky things that are meaningless and blow them up to try to mean something. Tesla is actually correct when they say delivery efficiency increased, and days of sales decreasing proves that, no matter how you look at it, even if you think inventories rose, which we don't know if they even did. But the fact of the matter is that Tesla is so clearly more efficient at delivering vehicles, it's just so obvious, and this guy can't see the forest for the trees. Tesla was able to deliver 139,000 cars this quarter, almost every single car that they produced. How were they able to do that if last quarter they only did 90,000 cars, and the prior quarter they did 88,000 cars? Given that the cars don't drive themselves to customers yet, this business is very difficult to scale. It's not like Amazon Web Services where you can instantly increase your delivery people when you have a spike in deliveries. The fact that they were able to deliver that many cars is crazier than you might think. Even Elon Musk has been saying how difficult this year has been for them so far. There are definitely growing pains when you go from 90,000 to 140,000 cars in a single quarter, and so it's highly likely that Tesla is the most efficient that we've ever seen them being at delivering cars. Alright, so now let's switch gears and look at the income statement and estimate how much money Tesla will make in Q3 given the number of deliveries that they have. Alright, so for automotive sales, I took the last quarter revenue and used 139,000 vehicles instead of the almost 91,000 they delivered last quarter. As always, I do like to err on the side of being more conservative, so I rounded down, which hopefully takes into consideration that Tesla actually lowers its vehicle prices a little bit each quarter. That said, Model Y is still being sold in its premium version models, which are more profitable, so it's possible that Tesla has a bit more upside compared to what I'm forecasting. For leasing, they did 5.5% last quarter, and this quarter it's 7%. I mean, they sold way more cars, so leasing should jump. To me, this is a little bit high, but we'll go with it and we'll see. Energy and storage revenue, I'll say it's the same as last year. I would obviously like to see an increase here, but I'm not sure if or when Tesla will have enough batteries to really boost the energy business. Eventually, they'll be able to do this. One of these quarters, I'm expecting to see an increase in solar sales as well, so Tesla needs to surprise me, but for now, I'm not expecting anything big with my estimates. In terms of service revenue, last quarter was artificially low due to people staying home. I think that's going to be ramping back up, so I said $550 million in service revenue, so total revenue is $8.7 billion. Now let's have a quick look at the analyst estimates for the quarter. They're calling for 8.17 billion on average. Again, I think that's a good estimate. If the analysts were expecting 9 billion, like this high estimate here analyst who's expecting 9.68 billion, then I would be a little bit worried. I think Tesla can beat 8.17 as per my estimates, and I didn't really forecast for any growth in energy or services. Alright, let's continue my estimate for net income. And by the way, I'll make this spreadsheet available on our Patreon, patreon.com/themarketisopen, and I put the link in the description. So for cost of automotive sales and leasing, I used the same percentages as last quarter. I think that should be conservative because for each new car that Tesla produces above a certain threshold, perhaps 80,000 cars, each new car is cheaper to make after they paid for their fixed costs, like turning the factory lights on, for example. So the fixed costs are already sort of baked into the numbers. But if Tesla becomes more efficient, which they have, at producing more cars, 139,000 in this case, with about the same amount of factory space and employees and such, then each new car only really contains the variable costs such as the materials and the labor. Another way to look at it is that the fixed costs that they have to run the factory are spread over more cars this quarter, and so the costs for each car should actually be lower. Anyways, I used the same percentages of costs from the last quarter for energy and services as well, so we get $6.8 billion of costs, and we have $1.9 billion of gross profits left over. And that would be the highest gross profit ever for the company, about $400 million more than their highest quarter, which was Q3 of 2018. Actually, the third quarter of the year tends to be pretty good for Tesla. Okay, so research and development I think will jump back up to one of its highest levels that we've seen in a while. I think Tesla's hiring a lot of workers, and last quarter it was artificially pushed down due to pay cuts from the pandemic. SG&A, I said 750 million. They delivered so many cars this quarter, about 53% more than last quarter, so even 750 million might be generous, but it's also their all-time high for sales, general, and admin. If they end up reporting a number less than 750 million, then we'll see how efficient Tesla has really gotten, but I think this is a reasonable increase over the last quarter given the number of cars that they sold. So we get 1.095 billion in operating expenses and $828 million in income from operations. Interest income, I said, will stay the same. Interest expense, the same. I pretty much left everything the same, which wasn't really in Tesla's favor. And so any of these numbers could actually help earnings a little bit if they come in a little bit higher. In the end, we get $586 million of net income, which is about 5 or almost 6 times the profitability of last quarter. It should be noted that because Tesla split the shares 5-1, that they have 5 times as many shares, and so the earnings per share I got was 63 cents per share per the new shares. So it looks similar to last quarter, but it's in fact 5 times higher due to the stock split. Analysts are forecasting for 56 cents per share, so I'm slightly above that, and I think if a few things go right for Tesla, where I've underestimated them, they can handily beat analyst estimates for profit as well as revenue. Alright guys, I hope you enjoyed this video. Let me know in the comments what you thought about my financial analysis and if you agreed with my comments on deliveries from the Forbes article that I went over. Don't forget to hit the like button on this video, we'd super appreciate that, and please subscribe and hit the bell button to be notified of upcoming Tesla content. You can also support us further at Patreon at patreon.com/themarketisopen. A special thanks to Bradford Ferguson of Halter Ferguson Financial and all of our patrons that help to support our channel. Your support helps us to continue to make great content. Thank you guys so much for watching.